Interest rates hold a tremendous influence over the economy, shaping our financial decisions and steering the course of economic growth. This powerful tool, often underestimated, is wielded by central banks and monetary authorities across the globe. Interest rates, in essence, are the cost of borrowing money. They are a fundamental component of our economic engine. When a central bank sets an interest rate, it's making a decision that ripples through every corner of the economy. Let's think about it like a domino effect. High interest rates make borrowing more expensive. This in turn deters individuals and businesses from taking on new loans, leading to a decrease in consumer spending and business investment. On the flip side, when interest rates are low, borrowing becomes cheaper, encouraging spending and investment, which can stimulate economic growth. But it's not just about borrowing. Interest rates also affect the return on savings. High interest rates offer a greater reward for savers, while low rates might encourage them to spend or invest their money elsewhere. This can also impact the economy, driving changes in spending and investment behavior. Central banks and monetary authorities don't just randomly decide to change interest rates. They do so in response to various factors, such as changes in the money supply, inflation, and economic growth. For instance, if inflation is high, a central bank might raise interest rates to slow down the economy and reduce inflation. Similarly, if economic growth is sluggish, the bank might lower rates to stimulate activity. These institutions must carefully balance these factors. They want to keep inflation in check without stifling growth, and they want to encourage spending and investment without causing an economic bubble. It's a delicate balancing act, and one that requires a deep understanding of economic trends and indicators. So interest rates are a bit like the thermostat of the economy. Central banks and monetary authorities adjust them to keep the economy running smoothly, just as you might adjust your thermostat to keep your home at a comfortable temperature. Understanding the factors that prompt these institutions to adjust interest rates is a key aspect of economic literacy. And that's what we'll be delving into in the next scenes. Stay tuned. Increasing interest rates can seem like a daunting prospect, but it's a necessary tool in the hands of central banks and monetary authorities. But why? Well, let's delve in. Firstly, controlling inflation. Inflation is the general increase in prices over time, and it's often seen as a sign of a healthy economy. But too much inflation can erode purchasing power, meaning your dollar buys less and less. When central banks see inflation heating up, they might reach for their interest rate lever and give it a nudge upwards. Higher interest rates make borrowing more expensive, which can slow spending and investment, cooling off that overheated economy and bringing inflation back down to a more manageable level. Secondly, stabilizing the economy. The economy is a bit like a ship on the ocean, buffeted by various winds and currents. Sometimes it needs a little help to stay on course. When the economy is growing too fast, it can lead to imbalances and instability. By increasing interest rates, central banks can apply the brakes, slowing down the economy to a more sustainable pace. Lastly, managing the money supply. Money isn't just about coins and notes. It's also about credit, loans, mortgages, and other forms of borrowing. When interest rates are low, borrowing is cheap and money is plentiful. But too much money chasing too few goods can lead to inflation. By raising interest rates, central banks can tighten the money supply, making it more expensive to borrow, and thus keeping inflation in check. So, you see, raising interest rates isn't about punishing savers or borrowers. It's about steering the economy towards a path of stable, sustainable growth. It's about keeping inflation in check, ensuring the economy is stable, and managing the money supply effectively. Raising interest rates is a balancing act, aiming to keep the economy on a steady path. On the flip side, central banks and monetary authorities sometimes need to lower interest rates. But why? Well, there are several reasons. Let's break them down. Firstly, consider economic slowdowns. When an economy is not performing as expected or there's a recession, central banks often lower interest rates. This makes borrowing cheaper, encouraging businesses and individuals to take out loans. The idea is that this increased borrowing will stimulate spending and investment, thereby giving the economy a much-needed boost. Next, let's talk about low inflation. Inflation is the rate at which the general level of prices for goods and services is rising. If inflation is too low, it can be a sign that the economy is underperforming. interest rates can stimulate spending and push inflation back up to a healthier level. The third factor is an increased money supply. If there's too much money floating around in the economy, the value of that money can decrease. This is where central banks step in. By lowering interest rates, they can make saving money less attractive, encouraging people to spend instead. This helps to control the money supply, keeping the value of money stable. These factors, economic slowdowns, low inflation, and an increased money supply, all interconnect. For example, an economic slowdown can lead to low inflation as people spend less. This can increase the money supply as fewer transactions are taking place. In response, central banks may lower interest rates to stimulate spending and investment and get the economy back on track. It's like a domino effect, where one factor influences the next. It's a delicate balance, and central banks have to keep a close eye on all these factors to know when to adjust interest rates. But remember, these aren't the only factors. There's a whole host of other considerations that central banks need to take into account, from unemployment rates to political instability. It's a complex process, requiring a deep understanding of the economy and a keen eye for detail. Just like increasing rates, decreasing interest rates is a strategic move designed to stimulate economic growth. Adjusting interest rates is like walking a tightrope. It requires precision, caution, and a clear view of the economic landscape. Just as a tightrope walker must balance their body, central banks and monetary authorities must balance the economy. They must stimulate economic growth without stoking the fires of inflation too much. It's a delicate dance, a careful consideration of all the moving parts of an economy. Imagine an economy as a giant machine. Each cog and wheel has its role, and the smooth functioning of the machine depends on the harmony of these parts. The money supply, the rate of inflation, and economic growth are the key cogs in this machine, and they're all interconnected. So when central banks adjust interest rates, they're not just turning a knob. They're tweaking the speed of the cogs, the rhythm of the machine. Increase the interest rates, and you might slow down the money supply, keeping inflation in check. But go too far, and you risk stifling economic growth. On the other hand, decrease the interest rates, and you might stimulate economic growth by making borrowing cheaper. More money circulates in the economy. Businesses invest, people spend, and the wheels of the economy turn faster. But again, go too far, and you risk overheating the economy and sparking inflation. It's a balancing act. Like a tightrope walker, central banks must navigate a narrow path. They must keep their eyes on the horizon, constantly monitoring the economic indicators. They must be agile, ready to adjust their balance at the first sign of turbulence. And just as the audience holds their breath as the tightrope walker steps out onto the rope, so too do the markets watch the central banks. A misstep can have ripple effects, sending shockwaves through the economy. So, the next time you hear about an interest rate adjustment, remember the tightrope walker. Remember the balancing act that central banks and monetary authorities perform every day. Interest rates are a powerful tool, but they must be wielded with care to maintain economic stability. Interest rates are more than just numbers. They're the lifeblood of our economy. This statement encapsulates the essence of our discussion today. Let's revisit the key points we've touched upon. Firstly, we've examined how interest rates are a vital tool in the hands of central banks. They're used to manage the flow of money within the economy, influencing everything from the cost of borrowing to the returns on savings. We've delved into the reasons for increasing interest rates. This step is often taken when central banks observe an overheated economy, where the level of spending is outpacing the supply of goods and services. By hiking the interest rates, they aim to temper spending and prevent inflation from spiraling out of control. It's like applying the brakes on a speeding car, ensuring the economy doesn't crash into the wall of hyperinflation. Conversely, we've also explored the rationale behind decreasing interest rates. Lower rates make borrowing cheaper and saving less attractive. This encourages spending and investment, stimulating economic growth. In a way, it's like hitting the gas pedal, giving the economy a much-needed boost, especially during times of slowdown or recession. But it's not a simple binary decision. The process of adjusting interest rates is a delicate balancing act. Central banks have to weigh the pros and cons, assessing a variety of factors including economic growth, inflation, and money supply. They have to tread carefully, ensuring their decisions don't inadvertently tip the economy into chaos. In conclusion, the world of interest rates is complex yet fascinating. It involves a careful analysis of economic indicators, a deep understanding of financial markets, and a keen sense of timing. Understanding the factors that influence interest rates can empower us to make informed decisions, whether as policymakers, business leaders, or everyday citizens.